Thank you for joining us for today's market briefing. Over the past few months, there's been a lot of discussion in the financial markets about the resurgence of inflation. Today, we will dig into recent inflation trends, including looking at some key short-term drivers and addressing whether these trends are sustainable longer term. The Consumer Price Index has been accelerating in the past few months. As the reopening of the economy began, CPI reached new heights, with the most recent rate at about 5.4% as of June 2021. And according to this forecast, core inflation may remain above 3% through early next year. Let's dig a little deeper and take a look behind the scenes as to what is causing this trend. This chart breaks down the trend in core inflation, adjusting for the components that have been most sensitive to the economic lockdowns and reopenings during the pandemic. As we can see, the underlying trend in core inflation remains relatively tame at about only 2%. So what are those most sensitive components? This chart breaks down core inflation between primary goods and service components. Here the contrast is even more stark. We can see the significant price deflation for goods as the pandemic began, and then the subsequent surge in prices more recently. The quick and dramatic loss of supply during the pandemic has yet to fully adjust to the resurgence in demand, creating significant imbalances in many types of commodities and good prices. At the same time, we can see that the core services prices have been more stable. Importantly, the stability in service prices has helped keep longer-term inflation expectations in check. Here we can see that near-term inflation expectations are surging along with recent experience, while expectations 5 years out remain fairly modest. So how are these trends in goods and services likely to change in the remainder of this year? As supply and demand in different commodities and good markets comes back into balance, we are already seeing prices returning to more normal levels. On this chart in the upper left, we can see the dramatic spike and pullback in lumber prices as sawmills have rebuilt production capacity. Other commodity prices are also starting to roll over. Another example can be seen in the used car market, where prices have skyrocketed. Rental car providers sold down their fleets during the pandemic and depressed prices, but have now been rebuilding capacity as travel activity has returned. Coupled with the shortage of components and finished vehicles in the new car market, this surge in demand in the used car market has spiked prices. But as rental car fleet demand recedes, prices in the broader market should also follow lower. And the last and perhaps most important factor to look at for longer-term price trends is what's happening in the labor market. Here we can see the recovery in the jobs market over the past year. While there have been about 15 million jobs recovered since the worst part of the pandemic, there's still about another 10 million jobs to be regained before the labor market returns to its prior trend. Hence, the demand for workers is still below its prior trend. The good news is that job openings continue to rise and more employers are looking to rebuild their staffs. As the extension of unemployment benefits expires, perhaps more workers will return to the labor force and help bring the supply and demand back towards equilibrium. Thereafter, continued demand for workers would require faster wage growth. And as this chart emphasizes, we know that sustained overall inflation requires stronger wage growth rather than just surges in commodities and goods prices. As it stands today, we do not see a rapid enough increase in wage growth to signal that inflation will be sustainable for the longer term. The recent increase in unit labor costs is skewed by the loss of lower-paying jobs during the pandemic. Regardless, we will continue to watch this very closely in the months and quarters ahead. Monitoring developments in the labor markets will be important for investors to assess risk-reward in both stocks and bonds as we head into next year. In addition, it will be very important to watch the Federal Reserve's response if inflation persists at above-average levels for longer than expected. From all of us here at RMB, thanks for tuning in, and we hope you're able to join us for our next market briefing.